Welcome to Breaking News to Trading Moves.
Glad to be here.
Today, we are looking directly at a major headline that just crossed the wires regarding FedEx.
Yeah, the new guidance update.
Exactly. The company officially raised its full-year adjusted profit outlook, and, they lifted their revenue growth forecast.
Right, and that's coming right off a record holiday quarter.
Right. And on top of that, FedEx noted that demand in early March remained right in line with expectations.
Which is a really crucial detail.
It really is. So think of FedEx as this ultimate lie detector test for the global economy.
I like that analogy.
I mean, when consumers are scared or businesses are pulling back, the balance sheet of a major logistics operator feels the pinch before anyone else even notices.
Oh, absolutely. They see it first.
But today, that lie detector just gave the physical economy a bright green light.
That is the exact way to view this development. We are seeing a very clear company-specific transport story playing out in the market right now.
Yeah, and the market reaction was immediate.
It was. Following this update, FedEx shares moved higher, and investors are actively recalibrating their expectations for the broader physical economy.
Based purely on the operational data they just provided, right?
Exactly.
So our goal for the conversation today is pretty straightforward. We're going to look directly at this headline, examine precisely why FDX shares moved higher, and then walk you through the potential market winners and losers.
Just based purely on this specific update.
Right. We want to outline the direct financial read-throughs for the broader market so you can monitor the relevant watch lists.
And to set the table for you, it really helps to understand the position FedEx holds in the broader economy.
They're essentially a bellwether.
Right.
Yeah.
FedEx is widely viewed as a market bellwether. When we use that term, we mean it acts as a leading indicator for overall shipping activity.
Broad business demand, too.
Right. And corporate pricing power. Strong results here are highly positive for certain parts of the logistics and industrial space.
But, it's not all sunshine, right? Global conditions are still tough.
Exactly. Global conditions remain tough right now, and fuel costs are rising.
Yeah, the fuel costs are a major factor.
So because of those factors, not every company will benefit equally from the conditions FedEx just described.
Makes sense. Well, let's start with the main stock in focus, which is FDX itself.
The details here show really strong profitability.
Yeah, the update basically reinforces the reality that demand trends are holding up. You can think of FedEx as a corporate thermometer checking the temperature of commercial demand.
They see exactly what is moving and where it is going.
Right. So since FedEx handles everything from, raw materials to final retail products, why does their profit outlook specifically serve as a gauge for overall pricing power in the market?
Well, what is fascinating here are the mechanics behind the update. FedEx didn't just report that boxes were moving.
Right. Volume alone doesn't tell the whole story.
Exactly. They reported healthy delivery demand alongside stronger package pricing and improved margins.
Oh, wow. So they're actually getting paid more per box?
Yeah, that pricing component is the answer to your question. When a logistics provider can charge more per package and simultaneously improve their profit margins.
It shows pricing power.
Right. It demonstrates that their customers, businesses across the economy, are willing and able to absorb those higher costs.
Wait, let me make sure I'm following the logic there. You're saying that because a business accepts the rate hike from FedEx rather than pulling back on shipping volume, it proves their own underlying business is doing well enough to afford it.
That is the exact mechanism at play.
Interesting. That makes a lot of sense.
Yeah, the business customers cannot afford to stop shipping, and their own commercial demand requires the volume. So they accept the higher package pricing.
So they just eat the cost to keep things moving.
Essentially, yes.
Yeah.
However, the key takeaway for FDX right now is the tension playing out in the market.
What kind of tension?
Well, traders are actively weighing two competing factors. On one side, you have the focus on this improved profit and revenue outlook.
Right. And the other side?
On the other side, you have the broader fuel risks and geopolitical risks surrounding the entire transport sector.
Okay. But FedEx is managing it well.
Exactly. FedEx is navigating those risks successfully right now, which is why the shares moved higher.
Okay, so because FedEx proved that shipping volumes and pricing conditions are holding up much better than feared, other companies in the exact same line of work are catching a positive sentiment boost.
Yeah, they definitely are.
Packages aren't moving by magic. They require an entire ecosystem behind the scenes. This brings us to our first group of potential winners based on this demand read-through, the parcel and logistics companies.
If you were looking at the direct read-through, The specific names to watch are UPS, XPO, and CHRW.
Okay, so UPS, XPO, and CHRW. Let's look at why that group wins here. I mean, they don't have the exact same contracts as FedEx, so why does the market reward them today?
It really comes down to market sentiment and shared operational environments.
A rising tide kind of thing?
Yeah, sort of. When FedEx reports healthy delivery demand and stronger package pricing, investors immediately look at UPS, XPO, and CHRW and apply that same logic.
They assume if FedEx can do it, the others probably can too.
Right. The market reads the FDX data as a clear sign that overall shipping volumes and pricing conditions across the logistics sector are remaining sturdy.
So if the environment is accommodating for FedEx, the read-through suggests it should also be supportive for other major U.S.-listed logistics and freight names operating under similar macroeconomic conditions.
That's exactly it.
That makes a lot of sense for direct competitors. But what about the broader freight and supply chain operators? The specific names in this next bucket are ODFL, GXO, and EXPD.
Right. Those are the supply chain and freight operators.
I want to play devil's advocate for a moment, though.
Okay, go for it.
You mentioned earlier that the market is dealing with macro and geopolitical worry.
Yeah, definitely.
So if there are broader geopolitical fears looming over the market, why would companies tied strictly to trucking, warehousing, and forwarding see a benefit here? Shouldn't those fears, weigh them down?
This raises a really vital point about how markets process fear versus actual operational data.
Okay.
The macro and geopolitical worries you mentioned are very real, and they often cause investors to assume that commercial activity is slowing down.
Right. They assume the worst.
Exactly. They assume the worst. However, the update from FedEx proves that the freight backdrop has not fallen apart.
So the hard data from FedEx acts as a counterweight to the theoretical fear in the broader market.
Precisely. The market reacts positively because the actual movement of goods and the underlying commercial demand remains steady despite those macro fears.
So companies like ODFL, GXO, and EXPD, which operate in trucking and warehousing.
And forwarding and contract logistics, yeah.
Right. When FedEx shows that the broader demand for moving goods is still intact, investors start to believe that these supply chain operators will also maintain their steady business volume.
That's the logic.
Because if a massive volume of goods is moving through the FedEx network, those goods had to be warehoused somewhere first.
Absolutely.
They had to be moved on a pallet by a less-than-truckload carrier like ODFL before they ever reached a final parcel delivery network.
You are tracking the exact life cycle of the freight.
It's all connected.
Yeah, the physical economy is still functioning at a healthy pace, which benefits the entire freight ecosystem. It is a shared environment.
Right.
If the volume is there for the final mile, the volume is almost certainly there for the middle mile, and the warehouse operators handling the inventory upstream.
Okay, let's follow that life cycle even further upstream. We can move from the companies moving the boxes to the companies making the boxes and providing the fleets.
The industrials and packaging side.
Exactly. This brings us to our next group of potential winners. What are the names here?
The names in this category are PKG, IP, and R.
So we are talking about Packaging Corporation of America, International Paper, and Ryder System.
Right.
This is where the supply chain mechanics become really compelling for you as a listener, because we are looking at how closely linked these industries actually are.
They're completely intertwined.
Yeah, an uptick in FedEx volume mathematically requires more cardboard from a company like International Paper, and it requires more fleet support from a company like Ryder.
If we connect this to the bigger picture, you can really see the economic chain at work.
Definitely.
When parcel volumes and business shipping trends improve, it directly supports companies linked to packaging demand, fleet activity, and broader goods movement.
Right.
These stocks catch what we call a sympathy bid.
Okay, let's break down that term for a second. A sympathy bid meaning the market buys them up simply because they are standing next to the industry that just reported good news.
That is the practical definition, yes.
They just benefit from proximity.
Pretty much. They sit so close to the exact same economic chain that any positive data points in transport naturally flow into their operational outlook.
So it's about the procurement cycle.
Think about the procurement cycle for a moment. If businesses are shipping more products, their inventory of corrugated cardboard boxes depletes much faster.
Which means they have to buy more.
Exactly. Yeah. To maintain their shipping operations, they absolutely must execute larger purchase orders for packaging materials, from PKG and IP.
And on the fleet side with rider system.
The exact same logic applies to commercial fleet management.
Okay.
If logistics networks are running at high capacity, they require maintenance, leasing, and fleet support provided by R.
Right, trucks break down, they need parts, they need service.
The market connects those dots immediately. Stronger parcel volumes equal higher demand for the raw materials and the vehicles required to execute those deliveries.
Okay, now we need to pivot the conversation because the strong outlook from FedEx wasn't entirely perfect.
No, it wasn't. There was a major caveat.
Right. It came alongside a very clear warning about higher fuel costs. That requires us to explore who gets hurt by those rising costs.
The other side of the coin.
Exactly. You can think of FedEx acting like an umbrella in a rainstorm. They have the massive scale, and they have fuel surcharges built into their contracts, which protects their profit margins from the rain of higher oil prices.
That's a great way to picture it.
So what happens to the transportation companies standing out in the rain without that leverage?
Well, those companies come under immediate pressure. The first group of potential losers we need to examine are the airlines exposed to fuel inflation.
Okay, airlines.
The specific names here are DAL, UAL, and AAL, Delta Airlines, United Airlines Holdings, and American Airlines Group.
Wait, why do they face more danger than a logistics company? I mean, they both use massive amounts of jet fuel to operate their daily routes. Wouldn't the fuel inflation impact them equally?
They both consume massive amounts of fuel, but the mechanics of their customer base are completely different.
How so?
Airlines face much faster margin pressure when oil prices rise because they cannot always pass those fuel costs through to their flyers as easily or as quickly as FedEx passes them to corporate shippers.
Oh, because a family booking a summer vacation will just cancel the trip or choose a cheaper alternative if the ticket price jumps.
Right.
Whereas a business shipping critical inventory just absorbs the surcharge and keeps their supply chain moving.
That is the exact mechanism. FedEx has those fuel surcharges automatically baked into their B2B contracts.
It's just a formula, right?
Yeah, it is a mathematical formula that adjusts based on the price of oil. They have the scale to protect their margins without actively negotiating every single price increase.
But airlines can't do that.
No, airlines operate in a highly competitive consumer-facing space where raising ticket prices to cover sudden fuel spikes can instantly destroy travel demand.
So the airlines are trapped. They either raise prices and lose the customers, or they keep prices flat and eat the cost of the fuel.
Either way, they end up absorbing the cost of that fuel inflation, which compresses their profit margins.
That makes total sense.
And investors know this, which is why airlines are often viewed as potential losers when a major transport company warns about rising fuel expenses.
Okay, that brings us to the second group of potential losers. Transport companies with less pricing power. We're looking at LSTR, HUBG, and WERN, Landstar System, Hub Group, and Werner Enterprises.
Right. The update from FedEx really highlights the gap between massive diversified operators and smaller transport firms.
The scale issue again.
Exactly.
Yeah.
The issue for companies like LSTR, HUBG, and WERN is that they have far less leverage on pricing, less leverage over their suppliers, and less ability to mandate fuel recovery from their customers.
So if investors look at the market and believe FedEx is winning strictly because of its massive scale, that becomes a relative negative for the weaker operators.
Yes, in this environment, scale is a protective moat.
It's basically a shield.
Yeah. If scale is the primary reason for success during periods of rising fuel costs and tough global conditions, then lacking scale is a massive vulnerability.
They just get squeezed.
The smaller firms simply do not have the operational muscle to force through price increases the way a best-in-class operator does. They operate heavily in the spot market rather than relying on massive, long-term, insulated contracts.
Right, the spot market is volatile.
And when fuel prices spike, those spot market margins evaporate quickly.
Wow. Okay, we followed the trail of higher delivery and fuel costs from the logistics providers, past the airlines, and past the smaller transports.
We have to keep going downstream, though.
Right. Now we follow it all the way down to the final destination, the consumer-facing companies. This is our final group of potential losers, the downstream retailers.
The names to watch here are WETSY and RH Wayfair, Etsy, and RH.
Let me push back here as well.
Sure.
These companies sell furniture, crafts, and luxury home goods. They don't operate airplanes. They don't manage fleets of delivery trucks. They aren't direct competitors to FedEx in any capacity.
Yep.
So why does a transport read-through matter for them today?
Because they sit entirely downstream from these transport and cost trends. Their entire business model relies on the physical movement of goods.
So they're at the mercy of the transport companies.
Exactly. If fuel stays elevated, and if shipping costs remain firm, which FedEx just indicated is happening, these consumer and retail businesses face severe direct pressure.
Right, the delivery expenses.
They rely on moving physical products to consumers' front doors. If the cost of that delivery stays high, it eats directly into their profitability.
Especially for a company like Wayfair or RH, right? I
Right.
mean, shipping a pouch or a massive dining table is already brutally expensive.
Very true.
If the underlying freight and parcel rates remain elevated, the cost to fulfill those orders becomes a heavy burden on the balance sheet.
Exactly. And for a platform like Etsy, they rely on independent sellers.
Oh, that's a good point.
If those independent sellers are forced to pay higher shipping rates, they either pass the cost to the buyer, which dampens sales volume, or they eat the cost, which hurts the seller ecosystem.
And on top of that, they're dealing with the consumer side of the equation.
That is the dual threat. If inflation and fuel costs remain high across the broader economy, you often see weaker discretionary spending from everyday consumers.
Because their wallets are stretched thin.
Exactly. A consumer paying more at the gas pump is far less likely to purchase a luxury sofa or custom artwork.
So companies like WETSY and RH are squeezed from both sides.
Precisely. Their delivery expenses are remaining firm or climbing, while the consumer's ability to buy their discretionary products is potentially weakening.
So what does this all mean for you as you watch the market process this news? We want to leave you with the main question to monitor going forward.
It really boils down to one core question.
Right. Is FedEx telling us that the broader shipping cycle and economy are holding up better than expected? Or is this simply a case of one best-in-class operator winning because it has the scale, pricing power, and surcharge protection that others lack?
Depending on how you answer that question, your focus will change.
So if it's the first scenario,
If you view this as a broad positive read-through for the whole physical economy, then you watch the logistics, freight, and packaging names. UPS, XPO, CHRW, ODFL, GXO, EXPD, PKG, IP, and R.
but if you think it's more of a selective story favoring only those with massive scale and pricing power, then keep an eye on the airlines, the smaller transports, and the downstream retailers.
Right. There'd be DAL, UAL, AAL, LSTR, HUBG, WERN, WETSY, and RH.
Which reality are we truly operating in today? That is the ultimate test for the market to decide.
It's going to be something to watch very closely.
Absolutely. But I want to leave you with one final thought to ponder as you watch these specific names.
What's that?
Well, we talked extensively about scale being the ultimate advantage for a giant like FedEx, but we are also entering an era where artificial intelligence and advanced route optimization software are becoming commercially available to smaller operators.
Oh, that's a very compelling angle.
Right. Will that technology eventually close the efficiency gap? Could a smaller transport company use AI to optimize their fuel consumption and fleet routing to rival the margins of the industry giants, entirely altering who wins and loses in this environment?
It is definitely a trend worth watching closely in the coming quarters.
As a reminder, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.